While firms and companies are interested in taking a look at whether or not a project is going to be good for them, they are also interested in raising some type of financial capital. They may need some type of money right now to make some type of those investments or to undertake those projects. So anytime we talk about financial capital, that's just a really fancy way of saying some type of money. And if a firm needs money, the most conventional way for them to raise money is just go ahead and go to a bank, get some type of loan, they'll pay some type of interest on that loan, and they can use that money in order to conduct their business operations or to invest in some areas that the company may currently need. And that's the most conventional way. They may need to put up some type of collateral, but you just go to the bank, you get some type of loan, you get a cash infusion right away. However, there are more traditional ways for firms to get some type of money, and there are four sources that we take a look at. We take a look at stocks, we take a look at bonds, venture capital, and private equity. In this section, we'll go ahead and focus in on bonds first. So bonds are a debt instrument that promises to pay back a certain amount over time. And a lot of firms nowadays, if they need to raise money right now, they can go ahead and issue some type of bonds. Basically, when they sell bonds, they can sell it to the government, they can sell it to banks, they can even sell it to people like you and I. We give them money, and the company is going to take that money, and they are free to do whatever they want with that money for whatever to fund their business operations or any projects or investments that they may have. And then they're going to promise to pay us back or whoever buys the bond back at a later time period. So let's go ahead and see what the components of a bond are going to be and what we as investors care a little bit more about. And bonds are going to be a financial asset that you and I can actually invest in, just like what we could with the annuities. And bonds are a great place to go ahead and put your money if you're looking for a relatively safe asset, because you're almost guaranteed your money depending on the sort of sources or places where you put your money in terms of the bond, whether it be the government or with the company. So let's go ahead and break down the bond components first. So here, just starting off, we want to note that a bond is a debt instrument. So debt instrument, meaning it's some type of IOU. We are adhering to some type of contract, and the company is agreeing to pay us back at a later time period. So the company is put into debt anytime they want to issue a bond, but they do get some type of money right away. And anytime a company is going to go ahead and want to issue a bond, they have to give some type of bond contract, and there are three components to a bond contract in every bond contract that you're going to see. So components to a bond contract of a bond contract. The first component of a bond contract is something known as the face value. And the face value is the value of a bond that is repaid at maturity. So value of a bond that is repaid at maturity. That is repaid at maturity. So if you hold this bond all the way till maturity, that tells you that you are going to go ahead and get the face value. And the face value is typically in denominations of 1,000. So 1,000, 10,000, 100,000. Next is the maturity. And the maturity tells us exactly how long the bond is going to last. So life of the bond. And bond maturities can differ greatly in length. They can be 1 week bonds, 1 year bonds, 1 month bonds, 10-year bonds, 30-year bonds. It all really depends on what the bond contract is going to say. And at the end of the life of the bond, that's where the face value is going to be repaid. Finally, the most interesting component is going to be the coupon rate. And the coupon rate is a fixed payment to bondholders measured as an annual percentage of the face value. So here, coupon rate, a fixed payment to bondholders measured as an annual percentage of face value. Measured as an annual percentage of face value. So here, the coupon rate, it typically is a percentage, but if we want to go ahead and figure out the specific dollar amount, we take the coupon rate percentage and multiply it by the face value. So if a bond gives you a 5% coupon rate and you have a face value of $1,000, 5% times 1,000, that'll give you $50 in terms of a coupon payment. And that's going to be paid to you $50 every single year. And of course, the coupon rate can differ. There are a lot of different bonds that pay you on a semi-annual basis, a monthly basis. We'll focus in on the one that pays you every single year. And it's very important to note that these three components of a bond, they cannot change at all. Cannot change. So once the bond is sold to someone, they are set in stone. These three things are never going to change at all. So what is the bond process looking like? What exactly does the process of a bond, buying and selling a bond, entail? So suppose that we take a look at a company. So suppose Apple needs money right now in order to fund whatever operations they may need. They can go ahead and raise money by issuing some type of bonds. So right now, right here at the current time period, Apple decides to say, okay, let's go ahead and give you a bond with a $1,000 face value with a 5% coupon rate that has a maturity rate of 5 years. You as an investor can say, okay, I think that buying this bond as a financial asset for myself is going to be a really good thing for me. So you go straight to Apple when they first issue this bond and you go ahead and pay them the market value of this bond, which is coincidentally equal to the face value at this time period. So you give Apple $1,000. Apple gives you a piece of paper saying that you hold the bond, and Apple says, thank you for your $1,000. I'm going to go ahead and have a little bit of fun with this $1,000. However, by you holding that bond contract, by holding this debt instrument, it entitles you to a few things. It entitles you to a coupon rate every single year. So that 5% coupon rate times the face value times that $1,000, Apple is going to pay you $50 every single year. So in year number 1, Apple pays you $50. Year number 2, Apple pays you $50. That's just a reminder to Apple saying that, hey, we are giving you some type of return just for letting us use your money right now. And this occurs for as long as the bond is going to last. So here it happens for 5 years. Year 1, year 2, year 3, year 4, year 5, you get $50. However, when we hit the end of the 5th year, what exactly happens? That's where the bond is going to expire, the maturity is up, and Apple says, okay, I have to repay you back your face value, and the face value on that bond contract was $1,000, so you get your original $1,000 back. And this entire process right here is exactly why so many financial investors like to have some type of bonds within their portfolio, because they are seen as relatively safe assets. If you invest them in very, very safe areas, you're almost guaranteed your money back. You pay $1,000 or the market value, the face value, and you're going to get that original investment back when the bond matures, but you get a little bit of something extra with the coupon payments, and that's going to be your return for holding onto the bond. So bonds, very, very safe assets compared to things like stocks and annuities and other areas. So you want to go ahead, and if you want to go ahead and invest in somewhere safe, bonds are a great place to put your money into, especially in government bonds if you are risk averse. So what we want to go ahead and see with this bond process is what we as investors are going to be a little bit concerned about, and that's going to be the return. So what investors care a little bit more about, what investors care about is the return, and that return is something known as the yield. So Y-I-E-L-D, the yield. And the yield is just a really fancy way of saying the return on a bond. So annual return to a bond, And in order to calculate out the yield, we basically have a formula, very simple formula once again. Yield equals the coupon payment divided by the market price of the bond. So market price of bond. And the market price of a bond is what you would pay on the secondary market in order to purchase a bond. So the market price of a bond is something that can change. You don't necessarily have to hold your bond all the way from when you buy it all the way to maturity. There is a very robust secondary for these bonds where you can go ahead and buy bonds from somebody else, or that is not being first initially issued by the corporation or by the government. So the market price of the bond is exactly what can change. It's the fair market value. It doesn't have to be equal to the face value. It can be greater, it can be less than, or it can be exactly equal to the face value depending on a few conditions. So if we want to find out the yield or the type of return that you get on a bond with a few numbers, I could say what happens if the coupon that you get is $600? What happens if the market price is say equal to $10,700? What is going to be the yield or the return that you hold on the bond if you hold it all the way to maturity? You just use this formula right here. It's going to be $600 for the coupon payment, $10,700 for the market price, and that'll give you 5.6% return or yield on the bond. That's pretty a hefty return, especially on a bond, but that's a really good return for this relatively safe asset. And we want to also note about the yield. We do notice that bonds typically are considered safe, but there are a lot of bonds that can be seen as relatively risky. And if we have a riskier type of asset, that means we have to be incentivized to hold on to it a little bit more with a higher yield or a higher return. So we do note that yield is going to be positively related to risk. Yield is positively related to risk. So the riskier an asset becomes, the yield has to be higher. Just in order for us to get compensated for that type of risk, because the riskier an asset is, the more likely we are to lose all of our money. So there are a lot of bond rating agencies. One of the most common ones, or the most famous ones, is known as Moody's. So what happens if Moody's downgrades the rating of a firm? Downgrades rating of a firm, say from AAA to C. So AAA to C. So AAA is the safest type of bonds that you can imagine. You're almost virtually guaranteed your money back. But C-rated bonds, these are junk status bonds, and there's a very, very high chance of default by the company, and there's a high chance that you may or may not see your money. So AAA bonds, very safe, but C bonds are very risky, very risky. And if this is going to be the case, what do you think has to happen to the yield on the bonds for this firm if they go from AAA to C? That tells us that the bond is going to have to give you a higher yield. So here we notice that the yield is going to have to be higher. So yield has to be higher, just in order to properly compensate us for the higher amount of risk. And we see this risk return sort of trade-off in a lot of assets. So what happens if we take a look at stocks? We know that stocks are really risky compared to bonds, but stocks over a long period of time have returned you a higher return on your money. We can even take a look at country bonds. So the United States, they offer bonds, and our bonds are seen as some of the safest assets in the world, and the yields on these bonds are ridiculously low. They're pretty close to about 1% or even lower, depending on the specific bonds that you take a look at. What happens if you take a look at, say, maybe Greek bonds? And Greece went through a very, very hard economic downturn, and they're still going through it right now. At the height of their downturn, Greek bonds were yielding you pretty close to about 30 to 35%. And that's very, very risky. That's a very good return, but they're also seen as very, very risky. So as we can see right here, bonds, we understand the idea of the bond sort of process. We understand that if firms or even governments themselves need money right now, they can go ahead and issue these bonds. And we have the three components of a bond and what we as investors are a little bit more concerned about, which is the yield. So one way for firms to raise money right now, we see more mature firms or more sort of traditional firms issuing these bonds to get this type of money. And we understand exactly what's happening with that.